Hello? Patience, you're saying no sound. Can you hear me now? Let me know if you can hear me now, because my sound should be better now. So welcome to the stream, and we want to look at one of the highly anticipated and sought after topics: evaluation and analysis of public sector financial statements. This is one of the fundamental issues in public sector accounting, and a couple of you have raised concern about it. For us to discuss it and look at it in much detail and look at what we need to do. So that is why we are discussing it today. Any comments, put it in the chat box for me, and give us a thumbs up on the video when you join the stream. In the chat box, I see MCA there. Patient said, okay, sound is on now. Okay, thanks, sir. You're welcome. Right, so welcome to the stream. Any questions, put it in the chat box for me. And if you know somebody that has to be part of the stream, do share the video with a person so we can get many students to be watching the stream today. So when it comes to analysis or analyzing financial statement in the public sector, it is quite different when we are analyzing financial statements in the private sector or in financial reporting, because the indicators, computations are going to be different. The analysis will also be different. The words we're going to be using, the statements we're going to be making. So unlike for profit-making organizations or in FR, where you'll be talking about sales is going up, cost of sales is changing, operating expenses changing, and all of that, capital employed changing. When it comes to public sector, the wordings are going to be a little bit different in that case. Vera Owusu, I see you. Welcome to the stream. And then if you join the stream, you can give us a thumbs up on the video and also share the video so we can reach as many students as possible. So when it comes to basically analyzing financial statement in the public sector, there are three broad categories of analysis that we're going to be looking at. The first one is what is referred to as the common size ratio. The second one is what we call the ratio analysis. And then the third one is the budgetary analysis. So these are the three broad categories of ratio analysis or interpretation of financial statements in public sector: common size ratios, ratio analysis, and then budgetary analysis. I see some of you joining the stream. Give us a thumbs up on the video when you join, and consider to share as well with others so we can reach many students. Now, in a simple language, when we talk about the common size ratio analysis, what is happening here is that we are just expressing the figures represented in the financial statement in percentages using the total revenue as the basis for the common size ratio. What does that mean? It means that, for instance, if we have the statement of financial performance, so we have statement of financial performance, and then let's say we have the revenue here, and we have the expenditure here. So revenue on top, expenditure down. So let's say under revenue, we have something like direct tax, indirect tax, grants. Then let's say the expenditure, we have something like compensation to employees, goods and services, interest expense. Okay, just an example. Then let's put in some figures there to make it sensible. So direct tax, let's say 100,000. Indirect tax, let's say 52,000. And then grants, let's say 25,000. So in total, our total revenue is going to be 177,000, and that's total revenue. Then we decide to get an expenditure. Mohammed Nasib, we are very grateful. Okay, Mohammed. So compensation to employees, let's say we have 30,000 in here. Goods and services, let's say we have 125,000. And then let's say interest, we have 52,000. So total expenditure for the period, let's say that is going to be 155,207. That is, if I'm right, 30 plus 125 plus 52. Yeah, 207. So this is just an extract, okay? This is just an extract of the financial statement that has been presented to us. So it's an extract of the financial statement. But we are doing a common size ratio. So what does that mean? In doing a common size or preparing a common size statement, like I said, it simply means we expressing the figures in percentages. Okay, we express the figures in percentages. So the common size, is going to be, now remember, when preparing the common size ratios, the revenue is going to be the basis. The total revenue is going to be the basis. It means we're going to be expressing all of these figures in percentages. So look at how it's going to be. So for the direct tax, that's going to be 100,000 divided by 177,000 times 100%. And that is 56.5%. Okay, it means that when it comes to the total revenue, direct tax is taking 56.5%. Let's look at indirect tax. 52 over 177 times 100. That is 29.4%. Then we come to grant. 25 over 177 times 100. That is 14.2%. Okay, or 14.1. So that at the end of the day, it becomes 100% in that case. So that is the common size for the revenue. Now, this is where I want you to make sure you follow me carefully in here. When it comes to the expenditure, remember, like I said, the revenue is going to be the benchmark. The revenue is going to be the basis for the computation. So if we want a common size for the expenditure also, the same thing. Compensation is going to be 30,000 divided by 177 times 100. And that's going to be 16.9. Goods and services will be 125 divided by 177 times 100. And that's going to be 70.6%. And then interest, 52 over 177 times 100. That's going to be 29.4%. All right. So when you finish, you're going to add it up, and that is going to be more than 100% for your information all the time. and that's going to be 116.9%. Okay, so if we want our net cash flows, our net cash flows is going to be this minus this, not net cash flow, sorry, net operating deficit. Because this is the statement of financial performance, we have to be careful about that. Net operating deficit. Now, why is it a deficit? It is a deficit because you realize that the total expenditure is more than what? The total revenue. So that's going to be 177 minus 205 or 207, and that's negative 30,000. All right. And so when we look at our common size, that's also going to be 11 or 16.9 in negative in that case. So this is what we mean by the common size ratio analysis. Remember, like I said, when it comes to analysis and evaluation of financial statements in the public sector or the evaluation analysis of public sector financial statements, three core things can be used. We can use the common size ratio, we can do the ratio analysis, and we can also do the budgetary analysis. Gloria, I see you. You are welcome to the stream. Then the next thing is, so this is our common size ratio. The benchmark rule is this, that all the time when we are doing the common size ratio, the total revenue for the period becomes the benchmark. So you're going to use the total revenue as the basis to get the ratios for each of them respectively. So that is the first thing, preparation of the common size statement. Very simple, sweet, straight to the point. Any questions, you put it in the chat box for me, and also consider to give us a thumbs up on the video. That way we get more engagement on the video, and YouTube will be able to push it so we can reach as many students as possible. So that is the first one, common size ratios. Then we come to the second thing, and that is going to be the ratio analysis proper. So I'm going to snap this up, post it on my Instagram, and you can follow me on Instagram as well, because the meeting details are posted there, so you can get. So let's come to the second one, ratio analysis. Now, ratio analysis generally provides a foundation for analyzing the financial statement of the government, and it also there to enable us to determine whether the government is actually doing well or not doing well in terms of the management of the public financial resources. Let's plug this guy. So unlike the Grace, I see you, you are welcome to the stream. So unlike the common size ratio, where we are just looking at the percentages of the total revenue and then making our decisions on that. Now, just some tips on interpretation. If you look at what is happening here, you realize that about 71% of the total revenue is going into what? Goods and services. 71% of total revenue is going into goods and services, which is the day-to-day running of the machinery of government. And that is huge, all right? Goods and services day-to-day running of government activity is taking 76% of total revenue. So how much revenue will be left for infrastructure, property, plant, and equipment? How much revenue will be left for social benefits? How much revenue will be left to undertake various projects and repay even loans? So that is the idea about what is happening in the common size ratio. But like I said, the common size ratio doesn't really give us an in-depth understanding of what is happening in the performance of the organization or of the entity. But one technique or module used which gives us a deeper understanding is what is referred to as the ratio analysis. Now, according to the or under the Public Financial Management Act 2016, Act 921, ratios and other regulations, ratios can be categorized into various classes. Ratios can be categorized into various classes. Now, if you remember, I have been mentioning the Public Procurement Act 2016, Act 921, because it's fundamental when it comes to public financial management. Definitely, you're going to be seeing a question where the examiner is quoting that act for you to be able to answer or make comments on. So under that, generally, ratios can be classified into three categories, okay? Three categories. The first one is what we refer to as financial performance ratios. Financial performance ratios. The second one is going to be financial condition ratios. And then the third one is going to be fiscal and cash requirement ratio. So these are the three broad categorization of ratios that we need to look out for, and these are the things that we must look out for. So financial performance ratio, financial conditions ratio, and then fiscal and cash requirement ratio. Okay, I see Hakim, Nhyira, you are great. I didn't join earlier. Don't worry, we've not gone that far. So you still be able to flow with us, hopefully. All right, so we've not gone that far. So you will still be able to flow with us. So let me get this, and then let's pick up the items one after the other and then talk about them. Right. So what are these ratios about and what do they actually cover? Irene Mauli, I see you. Welcome to the stream. Give us a thumbs up on the video when you join. And that helps us a lot to grow the channel. So what is it about financial performance ratios? What is it about financial conditions ratios? And what is it about with fiscal and cash requirements ratios? In a simple language, the financial performance ratios are used in measuring fiscal achievements of public sector entities. Okay, so the financial performance ratios are used in measuring the fiscal achievement of public sector entities. The fiscal achievement of public sector entities. And I'm going to break down what we mean by fiscal achievement in a moment. Then the second one, financial condition ratios. Financial condition ratios. These are ratios that measure short-term, medium-term, and long-term financial health of the entity in terms of its liquidity and solvency. Okay, so the financial condition ratios measure long-term, medium-term, and short-term financial health of the public sector entity. So either as a single entity on its own or as the government in general. That is what the financial condition ratios measure. So usually this is about your liquidity or the liquidity of the public sector entity as well as what? The solvency. Whether we have enough money available, whether we will be able to pay our debts as and when they fall due, what is our financial position at the end of the day. Then the last one is fiscal and cash requirement ratios. Fiscal and cash requirement ratios. These ratios measure the extent of fiscal attainment and the ability of the entity to meet its cash requirements to provide public services. The extent of fiscal attainment and the ability of the entity to meet its cash requirements to provide public services. So how will you be able to meet public cash requirements to provide public services? So what public services are available and how much cash will you need or do you have to be able to undertake those public services? That is what we mean by the fiscal and cash requirements ratios. So generally, under the Public Financial Management Act 2016, Act 921, and other regulations, ratios can generally be divided into these three categories. So remember, the first level is we're using three modules for assessing or evaluating public sector organizations' performance. The first one is the common size ratio. The second one is the ratio analysis. And the third one is the budget variance analysis or the budgetary analysis. We've spoken about the common size ratios and we are currently on the ratios analysis. The ratios analysis is what we are saying that it is categorized further into three things. That is the financial performance ratios, the financial condition ratios, and then the fiscal and cash requirements ratios. So these are the three core things that you must understand in that case. So what are some of the ratios that we can talk about in general in understanding how we assess the organization's performance? Now, in the exam hall, the examiner is going to request us, whether you like it or not, to appraise the financial performance and the financial position of the entity. Okay, the financial performance and the financial position of the entity. So the question we ask ourselves is, what are the ratios we're going to be calculating to assess financial performance? What are the ratios we're going to be calculating to assess the financial condition, that is the liquidity and the solvency of the entity or of the government? And what ratios do we use to assess the public services or cash requirements for public services? So let's break these down into their individual ratios and find out how we go about them. Any questions, you put it in the chat box for me. So when it comes to assessing financial performance, like I said, this is about the fiscal attainment of government. So what ratios are we going to be computing here? Let me list them down, then we'll take them one after the other and talk a bit detail about them. So financial performance ratios. Some of the ratios to be computed under financial performance or in assessing financial performance include the following: total revenue to GDP, two, wage bill to tax revenue, three, interest to tax revenue, four, return on equity, and then five, tax revenue per capita. Tax revenue per capita. So these are some of the ratios we can compute under financial performance. Then when it comes to financial position also, financial position ratios, I'm going to list them down here, then we pick them one after the other. So I see Gamba, you are welcome to the stream. So one, we have non-oil fiscal balance to GDP. Two, we have non-oil primary balance to GDP. Then we have debt to GDP. Then capital spending to total expenditure. And then the last one is debt per capita. The last one is debt per capita. And I want to try and squeeze it somewhere. I'm going to put it here, okay? Debt per capita. So these are broadly the ratios that I'm going to be focusing on today, and then talk to you a little bit about them. So let's take them one after the other. Our focus here is to know how they are computed, what they are about, what they assess, and how we can interpret them when making various decisions. So let's start with the first one, and that is going to be the financial performance ratios. And the first one we have there is going to be, let's see, so total revenue to GDP. So total revenue to GDP. Now, as the name suggests, total revenue to GDP simply measures how much revenue government is generating from the total GDP. Now, GDP is simply the gross domestic product. Now, the higher the total revenue to GDP, the better it is for the government. Because if the GDP is, say, 25 billion Ghana cedis, and total revenue of government of that is just 5 million Ghana cedis, then it means government is not generating more tax revenues. It means government is not getting more direct taxes, government is not getting more indirect taxes. So ideally, the total revenue to GDP, when it is higher or it is increasing, it's a good indication that government is generating more revenue from the GDP of the country. Okay, so I see something there. Let me see. Hi, teacher. Abdullah. Hi, teacher. I am Abdullah in Somalia. In my semester 5, I used to watch your videos. I availed myself to those lessons. So what I want to ask you is whether you offer an online class. Do you offer them? Yes, we have our courses available online, and you can WhatsApp us +233 548. Let me put that in the chat for you, so I can continue with mine. So you can send a message on WhatsApp about that, and your enrollments can be done. +233 50 114 9296. So you can send a WhatsApp message. So the contact is in the chat box 050 114 9296. Since you are in Somalia, you add +233, or you begin with +233 to be able to connect. So the higher the total revenue to GDP, the better it is for the country. Now, this is simply going to be your total revenue, okay, over your gross domestic product times 100. Total revenue over gross domestic product times 100. Like I said, an increasing total revenue to GDP is a better indication that government is generating a lot of tax revenues, and government is making a lot of money from the tax, from the GDP of the country. Now, I'm going to come back to that in a moment. Number 2, let's look at wage bill to tax revenue. wage bill to tax revenue. Like the name for this suggests, this has to do with the percentage of total tax revenue that is going into the payment of personal emoluments. You know, government is the highest employer or the largest employer in every economy. However, if it is spending a lot of its tax revenue in the payment of wages and salaries, in the payment of personal emoluments for civil servants, that means less amount of money will be available to be able to undertake infrastructure, property, plants, and equipment, or to provide social services to the citizens who the government is representing and whose money the government is taking care of. So ideally, the wage bill to tax revenue should be less. In that case, government will be able to have a lot of the money available to undertake other projects. I hope you are getting the concept. It is not just about the computation, but it's about the interpretation and how you need to structure the interpretation. So ideally, what we are saying here is that the wage bill to tax revenue should be reducing. Why is that important? Because tax revenue is the highest source of revenue to the government, direct taxes and indirect taxes. So when we pick direct tax and indirect taxes and add it together to get a total tax revenue, and a greater percentage of that is going into the payment of personal emolument or compensation to employees, it is not a good sign for the country. It is not a good sign for the entity. So that is that about wage bill to tax revenue, and that's going to be wage bill. And another name for wage bill I've said is compensation to employees or compensation for employees, that kind of thing. So wage bill over tax revenue times 100. Ideally, this rate should be low. This rate should be falling, which means that government will be having excess revenue available to undertake infrastructure, property, plants, and equipment, to do some social services, or to even invest in equity instruments to be able to make some returns, which we'll be looking at later, returns on equity. I hope you're getting the principle. Please, if you don't understand anything, in the chat box, you comment in the chat box, and I'll be answering all of your questions for you. Number 3, interest to tax revenue. Like the name suggests, the interest to tax revenue simply measures the proportion of total tax revenue that is used to pay interest on debt. Now, you got to be careful here when we are explaining this ratio, because it's some way. Now, if a greater percentage of the total tax revenue is used to pay interest, that means that less amount of money will be available to be able to undertake infrastructure, property, plants, and equipment, which simply means that government is borrowing a lot, or the public debt stock is rising. That is why government is paying a lot of interest. However, the fact that the debt stock of the country is rising does not mean we will start to say, hey, Ghana, we are borrowing too much, we are borrowing too much. No. If we are borrowing much and there is increase in our non-financial assets, there is increase in property, plants, and equipment, there is increase in infrastructure facilities, what it means then is that there will be future economic benefits from those infrastructure, from those property, plants, and equipment that will flow to the country, that will flow into the economy. For that reason, even though we might be paying a higher interest now, there is a future benefit of that, so it's a good thing. Nemo, if interest as a result of increase in our debt stock, and there are no much increments in our infrastructure, property, plants, and equipment, it tells you that the country is not doing well. It tells you that possibly we are borrowing the money and using it to pay recurrent expenditure, using it for goods and services, using it for payment of huge salaries to public servants or public officials. That is what we mean by the interest to tax revenue. So when you're explaining this revenue or this ratio, you got to be careful and understand various other indicators in the question to be able to arrive at a solid explanation on what is actually happening in the questions. So this is simply going to be your interest, okay, public net interest over the tax revenue times 100. Public net interest over the tax revenue times 100. Now, like I said, ideally, this should be lower as well, okay? Of your total tax revenue, just a small percentage of that should be going into interest. But if a higher percentage is going into interest, and we see that the debt stock is rising, and we are using the debt to finance or to build non-financial assets, to build infrastructure, property, plant, and equipment, then even though the interest to tax revenue is rising, since the debt is being used to finance infrastructure assets, which means future economic benefit will flow to the entity, then it is not something to be worried about as a country or as an institution. So that is what we mean by the interest to tax revenue. Next one, return on equity. Now, government has investments, or public sector entities have investments in various companies. Like Ghana government has some investments in various companies across the country, and they pay dividends and various forms of returns to the government every year. So the return on equity simply measure, this is just like ROSI, return on capital employed, okay? And this is just measuring or return on investment, ROI. This simply measures how much returns the country is making from its equity investments. How much returns the country is making from each equity investment. Again, ideally, the higher the return on equity, the better it is for the country. All right. The higher the return on equity, the better it is for the country. Right. I see some comments coming in here. Let's look at them. Does that mean that higher interest to tax ratio is a good thing? Yes, higher interest to tax ratio is a good thing, subject to the fact that the increase in the debt is being used to finance non-financial assets, infrastructure, property, plant, and equipment. So if you are seeing an increment in the infrastructure, property, plant, and equipment, then it tells you that the increase in the interest to tax revenue is not something to be worried about now, because there will be future economic benefits from those non-financial assets we are constructing now that will flow to the entity. So let me give you an example. Now, like I say all the time, if I'm teaching certain things like this and I give certain examples, it is not to represent any political party or being partisan. It is just driving the point home and making us understand what we are doing here very well. So let's say, for instance, government issues loan notes, and the loan notes is subscribed, and we raise, like, say, $5 billion. And that $5 billion, we don't see it to be used for any infrastructure, property, plant, and equipment. We don't see it in hospitals. We don't see it in roads. We don't see it in building or putting it into one district, one factory. We don't see it putting into anything. But the $5 billion was borrowed to just pay wages and salaries, okay? Was borrowed to just pay recurrent expenditure. It is not a good thing, because it tells you that the loan has not been used for any capital investment. So in that case, your interest to tax revenue will be going up, and certainly, since there are no increments in your non-financial assets, it means that it is not something that is good to the country or for the country. Richard Kwame Kwayeboa said, I'm back. All right, Richard, you are welcome. Give us a thumbs up on the video. When you join the stream and you are watching, give us a thumbs up on the video. It helps us to grow the channel. YouTube will be able to push the video so we can reach as many students as possible and be able to assist more students just like you who would need a lecture like this to prepare for the examination. And if you know there are some people who have to be part of the stream, click the share button and copy the link and share it with them so that they can also come and watch this video. So return on equity is going to be your return, okay, divided by equity investments times 100. Return divided by equity investment times 100. Now, like I said, ideally, the higher the return on equity, the better it is. Now, there are times when the equity investments may be going up, but the returns will be coming down. It could suggest that government is not probably appraising its investment opportunities very well. Hence, even though there is increase in equity investment, returns are being low in that case. So ideally, the return on investment is supposed to be high. Then tax per capita, tax revenue per capita. Tax revenue per capita. Now, Moses Linus Tete, I see you. Welcome to the stream. Give us a thumbs up on the video. Comment in the chat box with any questions that you have for me. Now, tax revenue per capita, what does this measure? Tax revenue per capita, what does this measure? Like the name suggests, this simply tries to assess how much tax revenue is generated per citizen of the country. Okay? And ideally, the higher the tax revenue per capita, the better it is, which means that almost everybody is paying taxes and contributing to the revenue of the country. But the sweet thing is that population may increase during the year by, say, 1 million, but your tax revenue per capita may be falling. It could mean that either government is not generating a lot of tax revenue, or the increase in population, many of them still are below the working class, hence aren't working, and so government is not able to charge any direct tax on their income. Or better still, people have lost their job or are out of job due to the pandemic or due to any other thing, hence they aren't working to be able to pay tax to the government. So that is what I mean by the tax revenue per capita. So in a simple language, that is going to be your tax revenue divided by the population. Okay, tax revenue divided by population. This is expressed always in currencies. So it will be times something Ghana cedis, because the answer has to be expressed in population. Sorry, in currency. Okay, so I'm seeing a comment from Grace. She said, how would you figure out the returns from the question? It will be directly given. It will be directly stated. Either you find it in the trial balance as returns, and it's on the credit side of the trial balance, okay, because that's an income, or when there is no debit credit, then you find returns on equity. It will be directly stated, or sometimes it will be found in the footnote that included in non-tax revenue, is returns that the government received during the year from its equity investment in maybe company A, company B, company C, right? So that will always be obvious in the question, Grace. All you have to do is either you will find it in the trial balance given to you, or it will be in the footnote about the returns. Does it make sense? Let me know in the chat box. So these are the first 5 ratios that we can compute when we talk about the issue in relation to financial performance ratios. Remember, like I said, my issue is not about the computation. As you can see, these ratios, there is nothing skirmishing, nothing serious about them. I mean, it's direct, you can fish them out and calculate it. But my concern is your ability to be able to write the English for the interpretation. That's the key thing, right? So you make sure that you understand how the interpretation is done and how you structure it out. Okay, Grace said, thank you, sir. You're welcome, Grace. So that is it about this. Let's move on to the financial position ratios. Now, I'm going to snap this and I'll post it on my Instagram page So you can follow me on Instagram, Nhyira Premium, because the meeting details and whatever we'll be covering will be posted on Instagram. So you will be notified and you can join the stream. So I'll be posting this as well on my Instagram page after the class. All right. Any questions for me? Put it in the chat box. Any questions? Put it in the chat box for me so I can answer you. So let's move on to these guys, right? To these guys, that is the financial position ratios, and let's see what we're going to be doing there. I see some of you joining. You are welcome to the stream. When you join the stream, give us a thumbs up on the video and also comment in the chat box. Okay, Hakim Kana said, can you touch on tax per capita? I think I explained that. Okay, but tax per capita, like I said, simply assesses how much tax revenue that is paid per citizen. Okay, how much tax revenue that is paid per citizen. Ideally, the higher this ratio, the better it is, which means that at least almost everybody is contributing to the tax of the country or of the entity. But if it is falling, it could also mean that the population is increasing. However, since the population is increasing, maybe a number of or a greater percentage of population is below the working class, hence they aren't working to be able to pay any tax to the government, or people are out of job and aren't working, hence they aren't earning any income so that they will be paying any tax on it in that case. Or better still, government isn't widening the tax net in such a way that everybody who is supposed to pay tax is actually paying tax. So these are the things that we can talk about in relation to the tax per capita. Hakim Kana, let me know if the explanation went down well with you. Let me know in the chat box. So let's move on. Now, when you hear the word non-oil, because the first ratio we want to compute there, or the next ratio we want to compute under financial position is non-oil primary balance. That'll be number what? 1, 2, 3, 4, 5. That'll be number 6. Non-oil primary balance to GDP. Non-oil primary balance to GDP. Now, when you hear the word non-oil, be careful about what is happening here. You see, what happens is that in the determination of the actual total revenue of government, the total revenue of government is made up of a couple of components, such as direct tax, indirect tax, non-tax revenue like fees, fines, forfeitures, okay, then grants, then revenue from oil sources, all right, revenue from oil sources. So when we are looking at the total revenue of the government, it's going to be composed, including these 5 components. But when we are really assessing the performance of the government, oil revenue, government doesn't really have control over it. Why? Because that is from nature. Why? Because they can determine what really is supposed to come from there. So if we are assessing the performance of the government, usually we use the non-oil position of the government and not the actual total position of the government, so that we will find out whether government is able to generate a lot of tax revenues, whether government is able to get a lot of non-tax revenues, whether government is able to get a lot of grants coming in or borrowing some money coming in. So we will almost always going to be assessing the government's performance from the perspective of non-oil revenue. What it means then is that anytime we pick the total revenue, we're going to be subtracting the oil revenue. So let me not get ahead of myself. Let's take them and then let's discuss it real quick. So non-tax primary balance is going to be your fiscal balance. I'm going to clean this line here, and then I need to adjust this a bit. So fiscal balance plus interest minus oil revenue divided by your gross domestic products times 100. Okay, times 100. Zolak, I see you. You are welcome to the stream. Give us a thumbs up on the video when you join. So the oil primary fiscal balance. Now, when we say the primary fiscal balance, the primary balance, there are two things you got to be careful about. We have the primary balance and we have the fiscal balance. Now, with the primary balance, it is where we pick the fiscal balance. Now, when we say the fiscal balance, what is the fiscal balance? The fiscal balance is simply your net cash, your net operating surplus or deficit. Your net operating surplus or what? Deficit. So when you subtract total expenditure from total revenue, what will be left is what is referred to as what? The fiscal balance. Now, when we are dealing with primary fiscal balance, it means we want to find out the government's position, assuming it is not paying tax. We want to find out assuming it is not paying any interest on debt. That is why we call it what? The primary balance. So, because we are dealing with non-oil primary balance, we will take that net operating surplus or deficit, which is the fiscal balance, then we will add back the interest because we are assuming that government isn't paying an interest when we are doing this non-oil primary balance. Then we will subtract the oil revenue because remember, we are dealing with what? The non-oil position of government. Hence, we subtract the oil revenue and then we deduct that by the GDP of the country. Now, ideally, in the interpretation of this ratio, what happens? We expect this to be going at the end of the day. That, okay, the primary fiscal balance of government as compared to the GDP of the country is going up, which means that government is getting a lot, government is generating a lot, but this one doesn't give us the true picture of government's performance. Why? Because you know government borrows a lot, especially Ghana, right? We borrow a lot. We have borrowed and borrowed and borrowed and borrowed and borrowed. We borrow a lot. And so because government borrows a lot, it pays interest. So when government pays interest, it means that when we assess government's performance using the primary balance, that's not a good indication. That is why the second one will be used 7, and that is non-oil fiscal balance. This is the real position of government. This is the real position of government. So here we are assuming that everything is being paid, all expenditure paid, all revenue, all interests are also paid by the government, and that is going to be your fiscal balance minus just the oil revenue over the gross domestic products times 100. Your fiscal balance minus the oil revenue divided by the GDP. So primary balance is the net operating deficit or surplus, which is called the fiscal balance. Then we add back your interest. That gives us what is called the primary balance of government. But when we want the fiscal balance of government, all we will do is to pick that net operating surplus or deficit. I hope you are getting the picture. That is very, very important in that case. But remember, we are dealing with non-oil. For that reason, if as part of the total revenue of government, there is an oil revenue in there. Now you say, Nhyira, how do I get the oil revenue in the question? It will be stated in the footnote that of the total non-tax revenue, oil revenue is say X amount, so that you can deduct that from these figures respectively and be able to calculate your non-fiscal balance to GDP. Your non-fiscal balance to GDP. Hakeem, I hope you understand it now. You were saying I should go over again, and I just did. So I hope you get it now. Next one, 8. And that is going to be, let's see what I have here, debt to GDP. Public debt to GDP. Now, the public debt to GDP simply measures, like the name suggests, looks at the percentage of public debt as compared to the GDP. One of the things that when the vice president is talking about the fact about when people are complaining that Ghana, we are borrowing, one of the indicators he talks about a lot is the public debt to GDP. That yeah, the debt stock is rising, but our debt to GDP is falling, so it is not an issue. I hope you've heard that before, right? And it is true, all right? If the public debt is rising and your debt to GDP is falling, it tells you that, okay, to some extent, you are using the debt to invest in capital investment, hence you are generating a lot of GDP on that. For that reason, it makes that when you compare your debt to your GDP, it is actually falling. So when your debt to GDP is increasing, it's not a good thing. So like I said, the vice president usually say that a lot when he's analyzing about the public debt stock. So when the opposition people are saying that, oh, he will stand and he will say, okay, yes, we are borrowing. Yes, our debt stock has increased, but our debt to GDP is now 48%, as compared to previously it was 62%. Then they will clap for him. Okay? Why? Because we are borrowing though, but it means that the money is being put into projects, is being put into activities, and there is GDP coming inside, so it's a good indication for the country. So like we see, it's going to be the public debt over the gross domestic product times 100. So when your public debt to GDP is rising, it's not good. Your public debt to GDP should be falling, which means that not only are you managing your debts very well, but also you are putting the money into the economy and it is generating value for goods and services. For that reason, that is why you are doing well as a country. So that is what you must understand when we talk about the issue in relation to public debt to GDP. I hope you are getting the explanation. And like I said, if you hear me talking about anything, it's not political or something like that, right? It's about driving the point home so that you'll be able to really understand what you know. I hope you've heard this thing before, but you may not understand. Why is the vice president always talking about public debt to GDP? This is it. If the debt to GDP is falling, it tells you that we are not supposed to get worried. So even though the debt stock may have double or triple or whatever it is, we are in a good hands. Literally, you know, we are in a good hands. So that is the public debt to GDP. Dachi, all right, I see you coming to joining the stream. You're welcome. Any questions, put it in the chat box for me. Next one, capital spending to total expenditure. Capital spending to total expenditure. Don't want to go that far. Capital spending to total expenditure. Now, like the name suggests on this, the capital spending to total expenditure simply has to assesses the ratio of capital expenditure of the total expenditure of government. So if government's total expenditure for the year is 25 billion Ghana cedis, and capital expenditure in that is just 2 billion Ghana cedis, I mean, we're screwed. It means that government total expenditure, probably they are using it to pay wages and salaries. Maybe they are using it for the running of the day-to-day administration of government, which is goods and services, or they are using some percentages to pay interest, which is, did we do anything like interest to tax revenue in that case? So ideally, this ratio should be increasing. It tells us that, okay, government is investing into the economy, government is investing into infrastructure, property, plants, and equipment, and there will be future economic benefits actually flowing to the country. I see a comment there, and then you have not answered, you have not looked at my question above. What constitutes the fiscal balance? I have said that the fiscal balance is your net operating deficit or surplus. So when you prepare your statement of financial performance, revenue minus total expenditure, the figure you get is what we call fiscal balance. Does it make sense? The figure you get after deducting your expenditure from your total revenue, the net operating surplus or deficit you get, that is called the fiscal balance. I hope I have answered your question now. So this is going to be equal to your capital spending divided by total expenditure times 100. Now, ideally, this ratio should also be, like I said, increasing in that case, meaning that, oh, okay, we put in the money into capital expenditure, we are putting the money into non-financial assets, and it's a good thing for us as a country in that case. Now, you may ask, Nhyira, where do I get capital spending from? Yeah, you will get it in the trial balance. The examiner will tell you that during the year, there were purchases of property, plant, and equipment. During the year, they began a construction of something that is work in progress. Or during the year, the government acquired whatever thing. That means those are all capital expenditure. Okay, Hakim, you are welcome. So that is it about that. Then the next one is debt per capita. Debt per capita. This is it, debt per capita. One of the things that the Vice President talked about as well. Now, debt per capita is simply the public debt divided by the population. The public debt divided by population times Ghana cedis, because it has to be expressed in Ghanaian cedi or Ghana cedis, whatever you want to call it. Now, again, all right, we expect that the debt per capita should be falling, ideally, okay? But if the debt per capita is increasing, that doesn't mean the government is not doing well. That doesn't mean the government is mismanaging the economy. That doesn't mean the government is borrowing by heart. Like I told you earlier, if your debt stock is increasing, and we also see that non-financial assets, infrastructure, property, plant, and equipment is also increasing, it tells you that there is future economic benefits coming in. But if the debt per capita is increasing, but we can't see any road being constructed, we can't see any hospitals being built, we can't see any schools being constructed. So where is the money going? So if you have doubled your investment, sorry, you have borrowed twice as the debt stock before you came to power, and then after some years, we can't see infrastructure assets, we can't see anything building up, that tells you that the debt per capita is increasing, and that is not a good sign. But if the debt per capita is increasing, but we see infrastructure assets, we see hospitals, we see schools, it tells us that the government is borrowing money and it is putting the money into the economy, and there will be future economic benefit flowing to the country at the end of the day. That is what we mean by the debt per capita. Then, let's see, I think, is that all I'm supposed to talk about here? 5. So how come I have 11 here? Talk about interest. Yeah, interest to total expenditure. Let me talk about that, the last one. Have I spoken about interest to total expenditure? Let me make sure We are not doing double work. No, we've not spoken about that. Interest to total expenditure. And like the name suggests, that is your public debt interest over total expenditure times 100. The public debt interest over total expenditure times 100. This is simply the percentage of total expenditure that is going into servicing of debt. Again, this ratio is not supposed to be high, because if your total expenditure again is say $10 billion and you are paying interest of say $3 billion, that's about 30%, and that may not be good indication. But again, if government is borrowing the money and the money is being used for infrastructure, property, roads, schools, hospitals, and there is increase in the non-financial assets of the country, then to some extent we can say that even though a greater percentage of our total expenditure is going into interest, there is future economic benefit going to come in the future. So these are some of the ratios that we can talk about under the financial performance ratios and the financial position ratios. I'm going to be snapping this as well and put it on my Instagram page. So if you don't follow me on Instagram, you can follow me on Instagram, and I'll be posting this there as well as our meeting details each day, so you can get a notification and plan ahead of that. Any questions for me? Augustine, I see you. Welcome to the stream. All right. So I'm going to be concluding around here today for our discussion on this. And it's my hope that you'll be able to understand this. If you miss something, make sure you rewatch or you watch the playback of the video and understand them very well. Like I said, my plea is not the computation, because chances are 9 out of 10 you'll be able to compute it. I mean, but then the interpretation is where you've got to be highly and very, very careful about. So that is it about evaluation and analysis of financial statement. This is not all it is. There are other issues like budget variance analysis, but for time constraint purposes, I may not be able to cover that as you are just studying your exams on Monday. Tomorrow we want to discuss about the pre-scene for the strategic case study. So if you know somebody watching who is writing strategic case study, or you are writing strategic case study, tomorrow 4:30 p.m. that is what we're going to be discussing. I'm going to take you through the pre-scene, talk to you about various things you must know and the various modules that you need to focus on, and how you can structure yourself in order to actually increase your chances of passing the strategic case study examination. So this is it about it. Thank you very much for joining the stream, and I'll see you, God willing, next week. Did I say next week? God willing, tomorrow, as we continue with our discussion. Like I said, even though tomorrow I'm going to be looking at strategic case study, you can join the stream if you have any questions in any other subject. Put it in the chat box. I will answer you. Then you can just click back and go and study in that case. Hakim said, you have helped me to get another question to answer. Thank you. That is awesome, Hakim. So now you know there is a question you're going to be answering, right? That is very excellent. Zolak said, splendid. Thank you very much. You are welcome. Revision on tax will be when? We don't pay the time constraints. I don't know, but we are looking at whether we'll be able to hold some sessions on Saturday as well as on Sunday, possibly in the evening from 6 p.m. thereabouts on Saturday and Sunday. Whatever be the case, follow me on Instagram, because the details will be communicated or posted on my Instagram page. So you can follow me on Instagram, and then the details will be there. But definitely we're going to be having some sessions so that we can cover a couple of things and then focus on some key areas in the other subjects as well. Patience Pinstel said, God bless you, sir. Bravo, God bless you, sir. Amen, and God bless you too, Patience. So thank you very much for joining the stream. It's always a pleasure coming your way and assisting you with something like this to enable you to be able to go into the exam hall confidently and ultimately pass the exams. Continue to study, continue to put in the work, but continue to put in the effort. Remember that you gotta put in the effort. That is how you're gonna do it. Don't relax. Don't say, oh, this thing is difficult. No, once you've registered, you've got to write the exams. And it's not just about writing the exams, but ultimately passing the exam. So all the best. Take care of yourself. Continue to study. And if you have any inquiries, you know what to do. You can reach us on 050-114-9296, 050-114-9296, 050-114-9296. So any inquiry, you can call or WhatsApp that line, and then you can be directed on what it is that you need to do. All right, Grace, you are welcome. Josephine Annan, thanks for the emoji. Avoka Gajesberg, God bless you too. Okay, so MCA, Patience, Vera Owusu, Mohammed, Gloria, Grace, Hakim, Irene, Kamba, Richard, Moses Linus, Zorak, Dachihine, Augustine, Gajesberg, and all of you guys. Thank you very much for always taking time to join the stream. It's always a privilege coming your way each day to assist you on something. So I'll see you same time tomorrow as we continue with our discussion. So we meet again tomorrow. Stay blessed, work hard, and remember, the exams is just next week. But don't be nervous because it's possible and you can make it. Bye-bye.